Is all this a sign of an IPO market returning to health? Will the enthusiasm continue? Joining me now on set is Sunaina Haldea. She is the Global Head of Private Capital Advisory at Raymond James. Are IPOs back?
Well, I think the window's open. We can feel the breeze, but is it fully open in that we can understand that this to be a sustained period of issuances? We do not know yet. I think having these debuts go well with Circle and CoreWeave certainly helps. The other thing that has been a great marker has been over 100 IPOs, 80% higher issuance in the first half of 2025 than the same time last year. Great signal for the markets. But we require policy stability. When you look at the IPO pipeline, it's not as full as the market would like. A lot of folks are in watch and wait mode, especially with regards to their trophy assets that are often held in private equity funds. They want to make sure that there's a clearly established window that opens before they launch.
That's what I'm remembering, is that the risk assets suffered especially in early April when the president rolled out those initial reciprocal tariff rates. And since the market no longer seems to believe with conviction that the president is going to end up actually following through on the level of tariffs that he said, we see the IPO pipeline filling the window open. But if he does, is there risk there for all this?
There is risk. And now we have another gating item in August as to whether he follows through, whether there's another retrade here. So investors are in let's watch and wait mode. Let's wait for policy stability on two fronts. What path is the Fed taking? And what path are these tariffs happening in terms of their implications on the economy? We'll see with the inflation prints tomorrow whether we see any pass-through coming good at all. So when there is a good line of sight that there's stability across the two, that's when you'll see the window really crack open fully and all the issuances that are waiting in the wings to come out. Right now, there'll be folks testing the market, as we've seen, but not quite in a sustained way.
Let me ask you about private markets in general. It's been a hot topic for a couple years now. We've talked to you about it. There's also this sense out there now that the excitement around private markets is changing the nature of how even decisions on investments are being made. And that might kill the goose that laid the golden egg. How do you see it?
Well, I think what's important is that because we've had really subdued capital markets on the public side over the last couple of years when it comes to exits and liquidity via IPOs, you've seen behavior patterns change in the private markets. What does that mean? Private equity runs on a clock, 4 or 5 years to buy assets, 4 or 5 years thereafter to sell assets. We've had a very bearish cycle over the last 3 years when it comes to selling things. You've seen M&A volumes down. We'll see if they pick up. We're starting to see all the green shoots in that direction, but we still need that full comeback after the 2021 period. We've started to see the IPO window open. We just talked about that. But we still don't have a fully clear path to selling some of the assets that were bought in that 2019 to 2022 vintage periods in private markets. That's what I think you're alluding to, John. Mm-hmm. What happens to those assets that are now 5, 6, 7 years old, sitting in private markets? They have to be sold. So the question is, how?
What do investors need to be careful of? Retail investors who are being pitched these private market assets for the first time. And my sense is they're being pitched it based on this long history of how these assets, these types of assets have performed. But we're in a period now where those assets aren't necessarily performing in the way that they used to.
Now, private markets is a very large asset class. Retail investors need to know what they're buying. There are certainly private assets that have shorter durations and more history of distribution. So private credit is an example. Secondaries market, another very good example, where the J-curve, where the time between investing your first dollar and getting your the same dollar out is much, much shorter and not as deep a period of time to wait. So all of those strategies help. In fact, those are the strategies that have seen the most traction from retail investors over the last year and a half or so. Now, the other thing for them to watch is making sure that the liquidity profile matches the assets they're buying. If they're buying long-dated funds in an interval fund structure, then they've got to know that there isn't much liquidity there in the short term. However, if they're buying shorter-term instruments, maybe they can be more tolerant of that.